Today, we're cracking open the latest report from Kinei, a really interesting Japanese company that's part cinema operator, part real estate landlord. And on the surface, their numbers look incredible. But there's a fascinating puzzle hiding just underneath.
And this is the number that just grabs you right away. In their last quarter, Kinei's net profit shot up by a massive 22.4% compared to last year. I mean, that's the kind of growth that gets everyone's attention. So here it is, the central mystery we're going to unpack. How can a company be doing this well right now, but at the very same time be forecasting a huge drop in profits for the full year? It's a real head scratcher, so let's break it down. All right, first up, let's really get into just how good this quarter was. We'll start with those top-line numbers that paint this rosy picture. Okay, just look at the acceleration here. Revenue, up a very healthy 8.3%. But then operating profit, which is really a great measure of how the core business is doing, jumped even faster at 18.4%. And that incredible efficiency is what led to the huge 22.4% pop in net profit. So the story is clear. Kinei isn't just selling more, it's getting way more profitable. And we can trace all this back to one specific part of the company. The answer really lies in one half of their business. You got to remember, Kinei's basically two companies in one. And the cinema and amusement side was without a doubt the engine behind all this growth. And you can see how the company's built. It's pretty much split right down the middle. On one side, you've got the steady, predictable real estate business. And on the other, you have the much more exciting cinema and amusement business. And this quarter, well, the cinema side absolutely stole the show. So how'd they pull it off? With an absolutely killer lineup of blockbusters. Their theaters were packed for these huge cultural events. Everything from massive anime titles like the Demon Slayer Infinity Castle arc to the Chainsaw Man Ray's arc. Not to mention popular movies like Tokyo Mayor. These weren't just films, they were events driving massive ticket sales. And the result of that incredible movie slate was this, a 16.4% jump in revenue for the cinema business. Now, that's double the growth rate of the entire company. But wait, it gets even better. Get this. Even more impressive, the profit from that same segment skyrocketed by an astonishing 50.6%. A 50% jump. Wow. This just goes to show that every single extra ticket they sold was incredibly profitable. They managed their costs so well that the revenue boom went straight to the bottom line. It was pretty much a perfect quarter for their cinema business. Okay, but what about the other half of the company? While the cinemas were having this blockbuster party, the real estate division was playing a much, much quieter role. Yeah, this is the slow and steady part of the business. The focus here isn't on explosive growth, it's all about reliability. They just work on keeping their buildings full, collecting rent, and doing routine maintenance. It's designed to be predictable. And yep, the numbers tell that exact story. Revenue grew a modest 2%, and profit by about 4.1%. Nothing to write home about, but that's the whole point. This is the stable foundation that lets the cinema business swing for the fences. So, with one half of the business booming and the other half steady as a rock, the company's finances should be in amazing shape, right? So, let's pop the hood and take a look. A great quarter is one thing, but is the company fundamentally sound? Is this success built on a solid foundation, or is it all propped up by risky borrowing? To figure that out, we can look at a key metric called the equity ratio. Now, it sounds a little technical, but it's actually pretty simple. It just tells you how much of the company is owned outright versus how much is financed with debt. A higher number means a bigger safety cushion and less risk. And check it out. This is really good news. Kinei's financial foundation is actually getting stronger. Their equity ratio went up from 43.6% to 46.6%. What this means is that while they were making all this profit, they were also strengthening their balance sheet, not taking on more risk. So far, everything looks just perfect. So you'd think the company would be shouting from the rooftops, right? Raising its forecast, promising a fantastic year. But this is where our story takes a very, very sharp and puzzling turn. Let's just do a quick recap. Profits are soaring, up over 20%. The cinema business is on fire. The real estate side is stable, and the company's financial health is actually getting better. It's a textbook example of a company that's firing on all cylinders. But now for the puzzle. Let's look at what the company itself is telling investors to expect for the rest of the year. This is Kinei's official forecast for the entire fiscal year. And this is where it just gets weird. They project that by the end of the year, their operating profit, the profit from their core business that we were just talking about, will have fallen by nearly 19%. Ordinary profit is also forecast to drop by almost 18%. How? How is that even possible?
And this puts the whole contradiction in one place. After a fantastic quarter, operating profit is up over 18%. But the company is forecasting that the final 3 months will be so bad, the entire year will end up down by nearly 19%. It's a massive, unexplained disconnect.
So let's just be super clear about the key takeaways. We have a company that just delivered a knockout quarter thanks to blockbuster movies. Its finances are solid and getting even stronger. But Kinei itself is predicting a huge profit drop by the end of the year. And maybe the most telling detail of all is that they chose not to update this gloomy forecast, even after reporting these fantastic results. They are deliberately sticking to their negative prediction. And that leaves us with the big question. What is really going on here? Is this just a classic case of a super conservative management team underpromising so they can overdeliver later? Or do they know something we don't? Is there a huge expense coming up? Or do they think the movie business is about to fall off a cliff in the final quarter? The numbers are telling a story of incredible success, but the company's own forecast hints at a completely different ending.